Okay, how do we become peaceful, harmonious traders? We must bring all things into balance. Your real need for money balanced with your losses in a row, historical volatility and losses in a row, your account size and losses in a row, and your psychology with your model. Let's start at one of the first ones. Trading psychology, what we're expecting. Well, you have a session time. This is the time of the day and how long you're willing to trade. You have an expectation of how much you should make during this time or you will not trade. Ask yourself, how much must you make during session? We all have things in life that demand our attention. These things create a time ratio to task in hand. Time needed to complete it over task in hand. Another way to say this is we have a real need for money. It's called a pay ratio. It's how much we need to make. Now, if I bring this up, and I'm going to draw just a couple things on here. Let's get rid of our arrowheads. This is going to be a little teeter-totter. And in the bottom, and this is my little blackboard, as down here, think about this. This is losses in a row, and this is your real physical need for money. And I need this. I need to live. And over here, this is losses in a row. Okay? Now down here, the fulcrum point is losses in a row. That's in the middle. So let's don't call this one losses in a row here. You can't have it on both sides. Let's come over and call this really correct sizing, correct small sizing, sized to losses in a row. This is what we want. Okay, so what will happen if I do something like this? I'm going to bring this up and I'm going to show you a spreadsheet developed by a brilliant little technician called Kurt Warner. And what Kurt did is said, if you take $5,000, this is how much you make per month, and that comes out to $250 a day or $31 per hour. If you're going to trade, that's your expectation and that's your skill set. Well, if we come over here and we say, look, I'm going to lose 5 times in a row and be down 1%. Well, if I'm going to do that on a $2,500 account, I'm going to start my lot size at 0.04. Well, what does that mean? Well, that means if I do win or I do lose, I'm going to lose 80 cents. Well, wait a second. This is way out of balance. On Kurt's thing on this end, we need to make $31.25 an hour, and we're making 80 cents. If I put $31.25, watch what happens. What we're expecting to make. Okay, we need to go look at this because our expectations are out of balance with our account. So I'm going to bring this up to like $1.50 a tick. Okay, so if I bring this up, I'm going to make $30. But if I lose 5 times in a row, my cumulative loss is going to be monstrous. 1, 2, 3, 4, 5, $1,500 or half my account. I'm completely out of balance. But if I go the other route, I only make 80 cents and I'm in trouble now because I'll quit trading. I don't make enough. I'm really pickled because I can't make 80 cents and work. That's not going to work either. So this is the first thing we can do. We can go and say, I need to balance my account size to some of this. Let's go to the next slide. So your loss in a row lead to risk of ruin. Now, risk of ruin is very high if a trader risks over 5% of his account. Okay, so for cumulative losses on his account, he could find himself without an account. What this means is my need, if I size to my pay ratio and risk of ruin, I become out of balance and all of a sudden my account plummets. Let me give you an illustration of that over here. If we come in and we grab our spreadsheet and we looked at this, we sized to $31 a tick, we're completely out of balance. That won't work. It won't work. I can bring in line the size of the account and losses in a row really simply. I can start trading at the 0.04 lots. Okay, so we will have solved one of these positions, but we won't have solved everything. We're going to be at 0.04 lots is how we're going to start. But we're only going to make 80 cents, $1.09. We're only going to make a little bit of money. So that's a problem. 0.80, or excuse me, at that lot size, we're only going to make a teeny amount. But we're in balance with our account. We're only going to be down 1% at 5 losses in a row. But we're going to refuse to work. Psychologically, we refuse to work. So our first teeter-totter is out of balance, but we have 3 teeter-totters here. We're going to grab this same teeter-totter and we're going to copy it. We have 3 that we have to bring into balance for 4. Okay, we're going to move this one over here. This one's now in balance. This is account size over losses in a row. Losses, sizing to losses in a row. Sizing to losses in a row. We can place this in balance. We just don't like it. It's totally in balance. We start small. And we balance the equation. We're in great shape right now on one of them, but we still have this one that's completely unbalanced. It's completely unbalanced. Either way we go, this teeter-totter's out of whack, and this is a total emotional teeter-totter. Okay, now, if we can't balance these, we are going to be in trouble because we now need to balance how far does something move in price and time to losses in a row. Now, historical volatility is price over time. How far is it moving up or down? So what does this mean? Let's pop this in, and we're going to come down here. We're going to erase this one when we're done because we're going to add another teeter-totter that we have to balance. And we're going to bring this up, and we're going to say, you know what? This is volatility right now. This is how far it moves. That's where trade sizing comes in. Let's just say the difference between those two are in this range. This range right here, we're not going to make that a color. Well, we're going to just change this. We'll leave it. That's the range we have. If that's the range we have and that's 40 pips, well, look, I'm going to size to 40 pips or 20 pips. So this is an easy thing that we can bring in balance. So let's bring something that we can balance, and we could teach you how to balance. We can have software do it. We now have movement. We have movement, and the sizing to losses in a row. So how far does it move? And we size to losses in a row and account size. Okay, we can do this. Now let's look at our spreadsheet that Kurt developed here. We're going to come over here and we're going to take a peek at this. Well, look at this. This is our distance to stop. It's 20 pips. Okay. We're now sized to losses in a row and volatility. So what have we successfully done? We've sized to losses in a row and volatility. Okay. If we can accomplish this, we'll bring harmony to our trading. If we cannot balance these factors, we'll be unable to find success in trading. Now, the next one, we've been talking about this one. We must balance the size of our account to number of losses in a row. And if we can do this, balance brings success. Well, this is key. So we've taken the size of our account to our losses in a row to the volatility. So we've hit 3 major points: account size, losses in a row, volatility. But we're out of balance psychologically. Now, the next thing we have to cover is how to overcome loss. If we balance losses in a row to your account size, this is done by finding out how many losses in a row we'll take normally, or how many the model takes, and what methods to use to overcome loss. To fix losses, we can change lots. We can increase or decrease them. That's limited to your account size. We can increase the target. That's limited to your account size. A target is limited to the movement of volatility. So you can say, hey, the euro doesn't move this far. You can't wish for 1,000 pips to make, and it doesn't move that far. Trade better or hedge. So this little Swiss Army knife are tools that we can use to overcome loss. Now, a money management profile is how a system overcomes loss, crossing from negative series of trades to a positive series of trades within a session. A session is something your mom taught you to do. You got to work for a session and make X amount of money. Session losses or cumulative losses on account or how much we are down for total for the session. So that's poorly worded. But for example, after 10 losses in a row, the cumulative loss is a product of the starting lot size of the position and the money management profile. They work in tandem. Balance of size of account and cumulative losses must happen. So watch. What we're going to do is we're going to bring this up. This is the money management section. If I lose, I'm going to increase my target to 1.18, so 18%. Well, this is your ATR. I can only increase it up to the ATR for the day. So here's my target. I went from 20 pips to 24 to 28 after I lost. This is increasing or decreasing your stop loss. And this is your lot size. Well, what if I increased my lot size? This is a money management profile. How I behave with my money management will determine how many losses in a row I take. But if I do this, I can overcome loss. Now watch. Look at net profit. After every loss, I come out to profit. I come out in profit after every single loss, all the way down. But my cumulative loss in this case is increasing. Now, I can only do this with one more thing that we have to bring up. We've got some more things we have to discuss, but what we can do is overcome loss with a money management profile. All right. Now, last, we must balance the model. To do this, we must understand an equity curve. This is the number of losses and wins displayed on the graph on the right. Some models, like the one on the right, will win small amounts. Like that's what the dashes are. $100, $100, $100, $100. And if they're left alone, will lose a massive amount. This is exactly what a naked put does. And a naked put has the same equity curve as a martingale system. Martingale means you just increase your lots forever. A trader's equity curve shows his relationship to money. Now, this becomes really important, but let me explain to you something before we get into this. I'm going to come down here. We'll erase this one. I have a teeter-totter right here, another one, and we're all about balancing stuff here. This is all about balance. If I bring this teeter-totter down and I say I take lots of losses in a row, lots of losses in a row, over 10, over 10, over 10. Now, over here, I take... on this side of the equation, I take few losses in a row. Few losses in a row. Now, this is balancing your money management profile of losses in a row. Well, increase of size is fine if you lose not very often is fine. If you rarely lose. Okay? Now, increase of target is fine if you lose a lot. Now, what this says is when you go to trade, this system over here on the right, it's something you have to pick, and this is all psychology. This, you will lose a small amount, okay? You'll lose very tiny amounts. We're going to put this in as a dash, okay? You'll lose a little bit, bang, 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 $100, $100, $100, and then you're going to hit a massive win up here, okay? When you hit that massive win, this represents one big win. Some people can do that. They're perfectly acceptable to trade loss. And I'm going to make some hasty generalizations about a person's relationship to investing. And I'm actually going to send them to, there's a gentleman I look up to a lot. His name's Jonathan Duggard. And I'm going to send this off to Duggard. He's also got a PhD in psychology. And this is my observations of people and how they invest and their relationship to losses in a row. Most people prefer to win. Here you're winning a little, and you take a loss. Well, let's pop over here and talk about the psychology of this. And this is really kind of fascinating. Oops, we'll cut that out. Well, we'll leave it in there. Let's grab it in here. We just got to grab our thing. Now, what do we do? Well, listen, your mind's relationship to losses in a row. A trader's equity curve is his relationship to money. What does this mean? As traders, we are influenced by how we were raised, where we were born, and the jobs of our family. To illustrate this point in trading, I'm going to make some generalizations about this effect and its relationship to the model or how it influences our own trading. Example, why do I not let my winners run? Why do I stop out so late? Why do I never take profit and always give back? Well, poverty and savers, if you were raised in a family that taught you to save, to buy cheaper and to work harder, as a rule of thumb, you'll hate taking breakout trades and will always take your winners off the table quickly. People under stress for money view the money on the table as need and will bank profits fast. At the same time, they will not care about the stop. They think that I'm already poor and I don't care. If I lose it, I don't care, but I need it if I win. It's kind of a rotten dynamic, but I call it the counting pollo problem, where you come in and you're scared because you're going to be out of money and you count how many chickens you have around because you need the money to eat. Now, entrepreneurs and rich men are different. Rich men get richer because they don't have to sell. They want to own something. Entrepreneurs fret over losses of their investments and cut their losses very quickly. Rich men fear being poor and cut their losses fast. So a rich guy can invest and take lots of little losses, and it never bothers him because he knows he can get it. So let's go back to this. This becomes super important. This really becomes important as a person. Lots of losses in a row will generally little small losses, and then you'll hit a huge win, just a huge win. Like you're going to cut your loss, and then the cows come home. This is usually how people that come from an entrepreneurial background or wealthy, were raised in semi-wealthy family where they never worried about money. This is how they trade. Poor people and normal people, let's say, that fret over money, and a bit taught conservative, will take profit. They're going to become out of balance it's not even out of balance. This one is a psychological problem that you have to just pick one model or the other. There's not really balance here. You just have to pick it. But if you pick the wrong model, you are out of balance. So if you land in this camp and you say, hey, I'm going to take a model that wins a little, you're out of balance with your psychology. So instead of balancing this one to losses in a row, you're balancing this one to id yourself. You're balancing it to yourself. You have to come in balance with yourself or else you can't trade this. And you have to pick a model that can be displayed that way. We did that again. I didn't mean to pop that up. My apologies. Let's go in here. Let's grab this. So our trading psychology, this is my Jonathan slide. Certain models cannot be traded by certain people. It will not agree with their id. And until they sort out their relationship with money, they'll struggle trading because you have to pick a model that matches this. Now, in summary, to size a trade correctly, we must accept the unconditional nature of movement. Meaning movement through price and time is not something we can control. It simply is something we must size to. So movement we can't control. Need, risk, and account size is our own reality. And to balance this, we must seek to understand ourselves. Without understanding self, you can't size correctly. So let's go through our teeter-totters that we have to balance. This one's out of balance still, and it's to losses in a row. But really, this one we balance. It's not to losses in a row. We're going to put this one to id. This has to be balanced to yourself. This one has to be balanced to your account size. This one, movement, has to be balanced to losses in a row. So we're down to balancing two things that can come out of balance with id, with ourselves. Okay, so these are the last two things that we have to hit. And I did that 3 times. That was not pleasant. Okay, let's grab that. Okay. Now, balance is achieved by bringing our need for money in balance with losses in a row and movement. To accomplish this, we use FAT tools. These are Forex-assisted trading tools. This is the purpose of a FAT tool. These tools trade for you to a certain level, then turn the trading over to you at the right time. Forex, above all other financial instruments, allows you to size to exact risk. What does this mean? In Forex, we can achieve a tick value of 0.01. At that value, why trade? We don't trade. We have a computer do it for us. So the balancing factor on the id right here, up here, what balances this is a tool. Now, what do I mean by that? Do you care if a computer trades at 80 cents? Can a PC trade at 0.80 cents profit for you? Of course, you don't care if a PC trades. Now, Noah, my buddy, calls this way of trading, he says Snow White sends off the 7 little dwarfs. And these 7 little dwarfs go work for you, and it's slave labor at 80 cents. But when it gets to too high a price, when it demands your attention, we send it over to the trader that has a skill set to deal with. This theory in trading is accepted by many dealing desks now, and it's called, not dealing desks, but institutions. It's called augmented trading. And augmented trading brings this up. They bring this up, and they say, hey, we're going to have a PC trade for you. Now, this is what a fat tool is and what it does. Thanks.